Hi everyone, welcome back. In this episode, we're going to price exotic FX options on USDIDR using Monte Carlo Simulation. Why Monte Carlo? Because real products in banks are rarely plain vanilla. Once you add path-dependent features like Asians, lookbacks, or barriers, the classic Black-Scholes formula is either not available or it becomes very fragile. So in this video, I'll show you, first, the market data we use as input. Second, how we simulate USDIDR under geometric Brownian motion in the risk-neutral world. Third, how the same simulation engine can price 4 exotic structures. And finally, some risk measures straight from the Monte Carlo. Let's start from the data. On this slide, you see the raw inputs that drive our model. The USDIDR spot history, IDR 10-year yield as proxy for domestic risk-free rate, US 10-year yield for the foreign risk-free rate, and the daily returns of USDIDR. From these series, we extract 3 key numbers: the current spot, the domestic and foreign interest rates, and the realized volatility of USDIDR over the last year. In a risk-neutral FX framework, the drift of the process is not my macro view. It's simply, and the uncertainty comes from the volatility we measure here. All of this is calculated in Python and then fed into the Monte Carlo engine. Now we move to the core of the engine, simulated USDIDR paths under geometric Brownian motion. Each colorful line is one possible future path of the FX rate over the next 6 months. We simulate 20,000 paths, 126 time steps, roughly daily trading days, using the risk-neutral drift and the annualized vol we estimated earlier. Why Monte Carlo instead of Black-Scholes? Black-Scholes only cares about S0 and ST, great for European vanilla options. Exotic options, especially FX structured products, depend on the whole path, averages, maximums, barriers being hit, and so on. With Monte Carlo, we can recycle the same paths to price any payoff that is a function of the path. That's why banks love this approach for complex books. Before trusting any price, we need a sanity check. Here we overlay the histogram of simulated terminal USDIDR at 6 months and the theoretical log normal distribution implied by our GBM parameters. You can see the 2 curves line up nicely. That tells us the Monte Carlo implementation is consistent with the analytical GBM model, and our sampling is rich enough. 20,000 paths is doing a good job. Once this check is passed, we can safely plug in any exotic payoff we like. Now we turn the same paths into exotic payoffs. On this slide, you see the discounted payoff distributions for 4 products. 1. Asian call ATM. Payoff depends on the average USDIDR along the path. It smooths out short-term noise, so the distribution is more concentrated. 2. Lookback call ATM. Payoff uses the maximum USDIDR over the period. This gives the trader the best level, so the payoff distribution has a fatter right tail. 3. Up and out call. Vanilla call with a knockout barrier at 110% of spot. If USDIDR ever trades above that barrier, the option dies. That's why many simulated payoffs are exactly 0. 4. Double no touch, 0.90 to 110. You get a fixed payout only if the FX rate stays inside the band for the whole 6 months. Either full payout or 0. Nothing in between. All of these shapes come from the same USDIDR paths. We only change how we compute the payoff. This slide shows ST on the x-axis and the discounted payoff on the y-axis. It's basically the payoff diagram under Monte Carlo. For the Asian call, you still see an upward slope, but the line is blurred because it depends on the average, not just the final point. For the lookback call, the cloud extends much higher. Whenever the path spikes intraday, the payoff can be large even if ST comes back down. The up and out call looks like a call payoff that suddenly collapses to zero after the barrier region. That's the impact of the knockout risk. For the double no touch, most simulations give either zero or full payout. The scatter shows how survival depends on where ST ends versus the band. This view is powerful for client education. You can literally show how payoff changes when the FX rate moves. Next, we convert discounted payoffs into option premiums. Each bar here is the Monte Carlo price as a percentage of spot per 1 USD notional. The look-back call is the most expensive. It gives you best of the path, so of course the premium is high. The Asian call is cheaper than the vanilla because averaging reduces volatility. The up and out is cheaper again. You sacrifice upside in exchange for lower premium. The double no touch has a small but non-zero premium, reflecting the probability that USDIDR stays inside the 0.90 to 1.10 band for 6 months. This is exactly where Monte Carlo shines. Even without a closed form formula, we still get consistent prices across all these structures using one simulation engine. Pricing is only half the story. For a real trading desk, risk management is everything. On this slide, you see delta and vega for each product, computed directly in Monte Carlo by bumping spot and volatility and repricing. Products with big upside, like the look-back call, naturally have high delta and vega. The up and out has lower delta because many paths knock out. The double no touch behaves more like a probability bet. Small delta, but quite sensitive to volatility. These metrics tell us how the book will react if USDIDR moves by 1% or if implied vol shifts by 10%. You can use this to hedge with vanilla options or forwards and to explain to clients where the main risks sit. So that's the full journey, from real Indonesian market data to a risk-neutral GBM for USDIDR, to pricing and risk managing multiple exotic FX options using one Monte Carlo engine. If you found this useful, please like the video, subscribe, and share it with friends who are into quant finance and Indonesian markets. Thanks for watching. See you in the next video, and stay rational in your risk taking.